Canada just gave first-time home buyers a massive gift, the First Home Savings Account, or FHSA. If you're planning to buy a home, this might be the most powerful savings tool you've never used. In this video, I'm going to break down exactly what the FHSA is, how it works, and how you can use it to save thousands of dollars on your first home. I'll also share strategies, mistakes to avoid, and how the FHSA fits with your TFSA and RRSP. Stick around, because this one account could make the difference between renting forever and finally owning your first place. So, what is a FHSA? What if you could combine the best parts of a TFSA and an RRSP into one account? That's exactly what the FHSA does. The First Home Savings Account is a registered plan launched in 2023 specifically for first-time homebuyers in Canada. It lets you save up to $40,000, tax-free, toward your first home. Here's how it works. When you contribute, you get a tax deduction, just like with an RRSP. But when you withdraw the money to buy your first home, it comes out tax-free, just like a TFSA. That's why I call it a supercharged savings account. You get the best of both worlds. Now, there's a common misconception. What exactly is a tax deduction? Contributing $8,000 doesn't mean you save $8,000 in taxes. It just means $8,000 of income you made that year is no longer taxed. For example, if you make $60,000, your taxes might be around $9,000. But if you put $8,000 into your FHSA, the government will tax you as if you only made $52,000. In that case, your taxes might drop to around $7,000. That means your $8,000 contribution actually saved you about $2,000 in taxes, extra money you can now put toward your home. Of course, these are simplified numbers, but it shows just how powerful the FHSA can be. Let's now review the contribution rules and limit of a FHSA. You can contribute up to $8,000 per year, with a lifetime maximum of $40,000. If you don't use all your room in 1 year, it carries forward. For example, if you contribute nothing in 2025, then in 2026 you can put in $16,000 at once. Inside the FHSA, you're not limited to just cash. You can invest in GICs, ETFs, stocks, or mutual funds, so your money can grow tax-free while you're saving for your home. There is a deadline. You can only keep an FHSA open for 15 years, or until you turn 71, whichever comes first. And if you don't end up buying a home, you can roll everything into your RRSP or RRIF tax-free, without affecting your RRSP contribution room. We'll talk more about that at the end of the video. Now let's look at a real-life example. Anna opens an FHSA in 2025 and only has enough to put in $2,000. That leaves $6,000 unused. The next year, in 2026, she can contribute that $6,000 she did not use plus the new $8,000 limit, for a total of $14,000. So even if Anna can't max out in 1 year, she can catch up the next. But here's the catch. She can only carry forward $8,000 max. Now back to our example. Let's say Anna cannot afford to contribute in 2026. You might think that in 2027 she'd have $6,000 from 2025, $8,000 from 2026, plus her new $8,000. That would be $22,000 total, right? Wrong. The FHSA only lets you carry forward 1 year's worth, $8,000. So in reality, Anna can only contribute $16,000 in 2027. This rule means you can still catch up, but only up to 1 year's worth at a time. And since you have 15 years to use the FHSA, losing a bit of carry-forward room by not maxing your FHSA out each year isn't the end of the world. You want to take advantage of all the benefits of the FHSA. Let's see if you are eligible. Here's who can open an FHSA. You're between 18 and 71 years old. You're a resident of Canada, and you meet the definition of a first-time homebuyer. Now, this definition is actually more flexible than most people think. You qualify as a first-time homebuyer if you haven't lived in a home you owned, or one owned by your spouse or common law partner, in the current year or the previous 4 calendar years. So if you sold your home 5 years ago or longer, you're back to being considered a first-time buyer for FHSA purposes. Here's the catch though, and this trips up a lot of people. If your partner owns the home and you live there with them, you're not eligible to open an FHSA, even if your name isn't on the title. So in short, if neither you nor your partner has owned or lived in a home for at least 5 years, you qualify. That's it. And if you do qualify, this is one of the best tax advantages available for saving toward your first property. So, you've been contributing to your FHSA and maybe even investing inside it. Now let's talk about the fun part, how to actually use it to buy your first home. Withdrawals from an FHSA are completely tax-free, but only if they're used for what's called a qualifying home purchase. Here's what that means in plain English. You must be a first-time home buyer at the time of withdrawal. The home has to be located in Canada. You need to have a written agreement to buy or build the home before October 1st of the year after you withdraw the money. And you must intend to live in the home as your main residence within 1 year of buying or building it. If you meet those conditions, every dollar you withdraw, including all your investment growth, is completely tax-free. Here's an example. Let's say you contributed $30,000 to your FHSA over a few years, invested it in ETFs, and it grew to $36,000. When you make a qualifying withdrawal, You get to use the full $36,000. No taxes, no penalties. Now, here's the best part. If you're buying with a partner who also qualifies, they can use their own FHSA too. That means together, you could have up to $80,000 in tax-free contributions and potentially withdraw even more if the investments grew. What if you change your mind after opening the account and do not want to buy a home anymore? No problem. As long as you haven't made a qualifying withdrawal yet, you can keep your FHSA open, keep investing, or even transfer the balance tax-free into your RRSP. And that transfer doesn't affect your RRSP contribution room. So either way, you buy your first home and withdraw tax-free, or you roll it into your retirement savings. Your money always works for you. Now let's talk strategy, because most Canadians are leaving free money on the table by not using their FHSA the right way. First, timing matters. Open your FHSA as soon as you can, even if you only contribute a small amount, like $100 a month. Why? Because contribution room only starts building once your account is open, and every dollar helps you save on taxes. Second, don't let your money sit in cash. Inflation erodes your savings over time. If you plan to buy soon, short-term options like savings accounts or cash ETFs make sense. But if your home purchase is a few years away, consider investing in diversified ETFs. They can help your money grow faster at the expense of greater risk. Third, here are some advanced strategies that most people don't know about. Number 1, RRSP to FHSA transfer. You can transfer funds from your RRSP to your FHSA tax-free. The catch? You won't get a new tax deduction since you already received one for the RRSP contribution. But this move can be smart if you're short on cash and want to avoid using the home buyer's plan, which requires repayments. Number 2, HBP and FHSA combo. You can also withdraw from your RRSP under the home buyer's plan and then contribute that amount to your FHSA before withdrawing it again. This gives you a fresh tax deduction, but remember, you'll still have to repay your HBP over time. Number 3, long-term play. If you don't end up buying a home within 15 years, you can roll your FHSA into your RRSP tax-free. It's a great way to grow your retirement savings while keeping all the tax advantages. Finally, let's go over a few common mistakes to avoid. Forgetting the 15-year limit. Once it's up, your FHSA must be closed or transferred. Waiting too long to open your account. Remember, contribution room doesn't build until you actually open it. Making non-qualifying withdrawals. Those are fully taxable, and you lose the account's benefits. So, whether you're just starting to save or already planning your first home, using these strategies can help you maximize your tax savings and reach your goal faster. The FHSA is Canada's best-kept secret for first-time homebuyers. It's deductible like an RRSP, tax-free like a TFSA, and tailor-made to get you into your first home faster. If you're planning to buy a home in the next few years, opening an FHSA should be at the top of your list. If you found this helpful, hit like, subscribe, and drop a comment. Are you planning to open an FHSA this year? I'd love to hear your plans.